Agora vamos olhar para o mercado norte-americano, com o nosso convidado especial. O painel será em inglês, esse link está com o áudio original. Caso você prefira com tradução simultânea, por favor, clique na tela ao lado. I will now switch to English. To talk about the U.S. fiscal policy and inflationary risk, we have the pleasure to invite Larry Summers, former U.S. Treasury Secretary during President Clinton, former director of the National Economic Council for President Obama, former president of Harvard University, and vice president and chief economist of the World Bank. For this conversation, I would like to invite our senior partner, André Esteves. Welcome, Esteves.
Well, good afternoon, everybody. Good afternoon, Larry. It's a pleasure being here with you again, talking about global status of the world. So let's try to make this very productive for our guests here, both in the audience and seeing us on the broadcasting. Well, you don't need any introductions. You have been doing a lot of relevant things, not only for US, but for the world in the recent years. But and then it's a pleasure to talk to you again. So with us, Professor Larry Summers. Professor, I think...
Let me just say I'm glad to be with you. I'm glad to be with your firm. Once again, your firm has a very strong reputation for excellence, and I always think that we North America pay less attention than we should to what's happening in South America, and so I very much always welcome the opportunities to be engaged in dialogues with you, and I look forward to the day when normality can return and an event like this can be taking place in person.
Yes, I expect that our next chat will be in person, like was the last one, right? This is a very atypical times. And regarding these atypical times, Larry, I think one of the key economic discussion and probably the most important economic discussion these days in the economic and financial communities are probably related to US and Europe economic recovery and especially normalization of monetary policy. We are seeing a very atypical moment where we do see growth, we do see inflationary pressure, probably a relevant one, especially if you consider recent times, and we do see still some unprecedented stimuli, both fiscal and monetary. So what's your view on that to kick off our conversation?
So I've had a concern now for quite some time about American inflation. And when I started having that concern, it was because I looked at the data as it stood in February of this year. And what I saw was that we were perhaps $30 billion a month low on labor income, and that we were setting ourselves up to do perhaps $200 billion a month in stimulus. And so it seemed to me that the stimulus we were providing was very large relative to the gap that we were experiencing. And I thought that when you pour too much water into the bathtub, at a certain point, it overflows. Relative to when I had, and I also thought that concern I had about the $200 billion versus the $30 billion was reinforced by the fact that monetary policy had its foot on the accelerator to the floor between zero interest rates and QE. And I thought that in addition to that fiscal policy, that we had a very large savings overhang, that the savings overhang took the form of all the spending that people had not been able to do in 2020 because of COVID, because they couldn't go on vacation, they couldn't go out for a restaurant, or whatever. So it seemed to me we had an enormous quantity of demand, and at best, supply was going to rise as fast as it would have in the absence of COVID, but maybe because people were going to retire early, businesses were going to close and so forth, COVID was going to linger, supply would be less than normal. And so it seemed to me with extraordinary demand and normal or less than normal supply, you were headed for a significant inflation problem. Frankly, inflation rose more rapidly than I would have expected. Maybe I should have had smarter expectations and realized that when you had demand starting to run ahead of supply, you were going to start to see bottlenecks in a variety of places without knowing what those places would be, and that those bottlenecks would start to cause some prices to rise very rapidly. And indeed, core inflation in the United States, measured by the CPI, was at close to a double-digit rate in the second quarter. Now, I don't think that's a reasonable measure of the underlying inflation rate. And I think that there's surely a transient element in some of what we've seen in used car prices and so forth. But I think there's also a substantial continuing component. And as I think about the future, the specific factors like used cars, like perhaps hotel rooms, where you're going to see some improvement, I think have to be balanced against three very large factors that concern. One is that on a go-forward basis, demand is going to rise much more rapidly than supply. People are looking for demand for GDP growth of 5 or 6% or more in the third quarter and the fourth quarter. And nobody thinks supply is going to rise that fast. Second, we have an incredibly tight labor market measured by what I think is the relevant standard, which is what's likely to happen to job openings. Job openings are at an extraordinary level right now. They're the highest they've ever been. And people are quitting their jobs at an unprecedented rate. Some people are using the term the Great Resignation. Well, in an environment like that, it seems almost inevitable that you're going to get substantial increases in wage pressure. They may not come immediately, but they're going to come. And the third factor that I think stands for substantial pent-up inflation is the housing market. I saw a statistic the other day that if you look at transactions where a tenant leaves and a landlord rents a residence to someone new, on average, the new rent is 17% greater than the old rent. Now, of course, that's not the overall rate of rental inflation, since many tenants stay and don't get inflation quite that fast, but that's what's coming, and that's what's going to be there. And you can see it in what's happened to owner-occupied housing. You can see it in how much enthusiasm there is on the part of investors for purchasing residential real estate of various kinds. So I look at those three things together, and I think what I see is the likelihood that the overheating is going to get to be greater. And that's what makes me think we're likely to have a continuing inflation issue. How is the Fed going to respond? My guess is the slower they respond in the short run, the harder they're going to have to respond in the medium and longer run. It's a little bit like braking a car for a red light. If you start well before the light, it's a more gentle process than if you start only as you're pulling up to the light to brake the car. I think that ending quantitative easing is the right thing to do. I can't imagine why it makes sense on an ongoing basis for the Fed to be issuing Fed paper, Fed reserves, which are a form of floating rate debt, to buy back long-term debt. You'd have thought that in a moment of unprecedented deficits, unprecedented uncertainty, the federal government's financial authorities would be wanting to extend the maturity of borrowing, not to be reducing the maturity of borrowing. So I think we should be QE sooner rather than later. And I think that that's a necessary precondition for increasing rate, which I think we're going to have to do to a larger extent than is now priced in markets.
Yeah, and Larry, we totally agree with you, and when you describe the balance of risks. But we have very sophisticated people at the Fed, and we are talking about well-known public data in this analysis. And once again, we totally agree with your point of view. But why do you think is driving the Fed, and in a certain way, even the ECB in a small instance, to be so aggressive in terms of monetary policy? Why not doing the tapering right now or announcing a more objective way a few weeks ago in Jackson Hole? Why we are being delaying so much in moving into the direction of normalization and taking other risks, right, of that I want to explore further, talking about asset price bubbles or inequality in terms of financial assets appreciation. Why the Fed's not is behaving this way? What would be your best reading of why they are managing monetary policy this way?
Let me say that I think the people at the Fed are enormously serious, dedicated, thoughtful, and wanting to do the right thing. And so I hope that while I am conveying some disagreement on my views, that I hope my respect for them as analysts and individuals is something that's very clear. I think there are a variety of factors at play. I would highlight three. One is, I think all of us, and anyone in a position to make decisions, wants to make new mistakes, not old mistakes. And the generals want to fight the last war. And the pattern for many, many years has been that if you were worried about it, it turned out to be wrong. If you were worried about inflation, you turned out to be wrong. And if you were concerned about overheating, the concern turned out to be unwarranted, and the rate at which the economy grew turned out to be slower than people thought. So after a long experience with false alarms about inflation and insufficient and excessive complacency about growth, there's a natural tendency to run to the other side of the boat. That's, I think, point one. And I don't think that's confined to the Fed. I think that's out there in much of the comment.
Yeah.
And the second thing is there is a general feature of institutions, which is that they are reluctant to take steps where there will be painful outcomes caused that seem to be causally linked to the steps that they have taken. And I think that is an additional kind of concern. It's the same reason why devaluations always happen too late. Devaluations always happen too late because everybody wants to avoid them. And everybody wants to avoid a slowdown or a bad outcome that's linked to a major decision they took. And so if you don't take a major decision, then if anything bad happens, it won't be blamed on your major decision. And I think that's a natural institutional imperative that explains why devaluations are late. It explains why people often get necessary surgical operations too late. And it's just a natural feature of behavior. And I think the third thing is that there's a kind of heuristic around COVID and a sense of COVID as a kind of overarching problem. And the idea that you need to tighten while COVID is still an issue, you need to do things that are in a tightening direction while COVID is still an issue, is, I think, a kind of counterintuitive notion. And I think the mistakes are failing to recognize just how much compensation we've given for COVID, which basically is much more compensation for lost income than there has been lost income from COVID, and a failure to recognize that COVID shouldn't be thought of as only or even as primarily a demand side problem, but by this point also has meaningful supply side aspects as well.
Well, Larry, changing to a different angle of the same topic, especially for us here, which is an audience of investors. If you look at the last 500 years of relatively well-documented financial history, every time that we had big monetary and fiscal expansion combined with innovation, we had some bubbles, financial bubbles or asset price bubbles. I have two questions regarding that. First, you were a senior policymaker for a long time in different moments of your career. First question is, how much do you think policymakers look at financial asset prices and as a consequence of the policies, and how much does it mind? And second, what is your view on financial assets? Because we see a number of signals, especially related to innovation in terms of classic bubbles. How your analysis of this moment?
So I'd say a couple things. First, I always say to my friends in the markets that you all think about policymakers more than policymakers think about you. And so
it's a very good comment. I would take a note of that.
So you all tend to think, the average Treasury Secretary at the average moment doesn't know what happened to the belly of the curve today. And the average Treasury Secretary at the average moment doesn't know what happened to the value versus the momentum factor. And they are just not thinking about the fact that it's a witching hour because of options expiration on the same day. So I think just as a general matter, if you try to think of policymakers as thinking about financial markets the same way you think about geopolitical matters. You're aware of them, but you're not really following the differences between Kandahar and Kabul. And that's how policymakers are thinking about finance. I think it will tend to be a useful perspective, tend to make you have more useful perspectives. I think that while there's some differences in opinion, I think most of the world's policymakers are reluctant to use monetary and fiscal policy as tools of financial stability, except for responding to crashes. I think it is quite uncommon for policymakers to come to the judgment, gosh, there are bubbles in financial markets, therefore I should tighten. And I think that comes from three sources. In part, it comes from humility. Who knows when the bubble exactly is? I'll give you two examples. Alan Greenspan famously used the phrase irrational exuberance in December of 1996, when the 300. Given what's happened for the subsequent 25 years, I think it's clear that there was no bubble at that moment in the equity market. Another example is in 1987, or in late 1987, there was an easy narrative that was almost universally accepted that the stock market had become a bubble in the summer of 1987, and it then crashed on October 18th. Look today at a graph of the S&P 500 from 1981 through the 1990s. What you would say is that there was some kind of weird air pocket in the fall of 1987, not that there was any kind of bubble previously. So I think there is a fair amount of humility on the subject of knowing when we're in a bubble. Second, there is this notion that I referred to earlier, which is don't be responsible for pain. If you burst a bubble and it bursts too hard or too far and there's various kinds of dislocation, then it's kind of your responsibility. If markets go down of their own volition, then they went down of their own, then that's what happened. So being an active agent that inflicts pain requires a substantial degree of confidence and a substantial degree of political strength, which there's often reluctance about. And I think the third thing is the pretty acute awareness of lags. At the moment when you're most sure there's going to be a bubble, you have to think about the fact that monetary policy, for example, operates with a one-year lag. And so if you know the bubble will go on for another year, it's a good idea to burst it, but maybe it was going to burst on its own. Maybe it's going to burst on its own in the next month or two. And if it does, then what are you going to do? Then your monetary policy is going to be contractionary, and you will have done a contractionary monetary policy on top of a problem that's already happening. And so I think those three factors tend to inhibit the inhibit policy from being very active in bubble burst.
Larry, since you mentioned the second half of 90s where you and Greenspan were the key policymakers, when U.S. U.S. will normalize monetary policy sooner or later, right? First with tapering, then with interest rates hike. And when it happened in the mid-90s, well, we had the Mexican crisis in 94, the Asian crisis in 97, Russian crisis in 98, Brazil crisis in 99. Do you think this time, when U.S. monetary policy normalize, we'll see the same consequence in emerging markets? Or, of course, situation is much better today. All the emerging markets have floating rate regimes. The quality of economic policy improved a lot in all the regions. But on the other hand, the interest rate differentiation is much lower today than used to be the second half of 90s. So what do you think will be consequence of normalization of monetary policy in U.S. to global emerging markets?
We're making sure on the internet connection here. There we go. It's a huge question, and I don't know the answer with confidence. Here's what I think it depends on. It depends upon how high rates have to go to achieve normalization. If normalization of interest rates means that somehow 1-year treasuries 3 years from now, 4 years from now, are going to be at 5%, 4%, the kinds of levels we thought of as historically normal. I think it's going to be a very difficult time in all kinds of risk markets. I think it's going to be a very difficult time in equity markets. I think it's going to be a very difficult time in credit markets, including sovereign credit markets. And I think it's going to be a very difficult time for emerging markets. So I think if necessary normalization is anything like a 400 or 500 basis point increase over the next several years, that's going to be a very difficult situation. And I think that if that comes into prospect as the likely outcome, I think that's going to be a very difficult prospect. If you look not just at forward rates, but you look at options markets to look at the distribution of possible future forward rates, what's being priced in right now is a very, very low probability of rates getting into anything like the 4 or 5% range for 1 year. And that's because there is a judgment that is very strongly held in the marketplace. Different people would use different words for it, but it's essentially a view that the secular stagnation forces that I was emphasizing in the pre-COVID period are very strong. Essentially, it's a view that widening inequality, changing demography, increased uncertainty, greater life expectancy is leading to increases in savings rates. And at the same time, a more intangible economy, lower priced capital goods, particularly for information technology, much less labor force growth, perhaps less underlying dynamism, is leading to much lower propensities to invest. And that therefore, market clearing interest rates are much lower than they used to be. And in the parlance of the moment, the neutral rate has fallen. And that even though you would expect an era of larger national debts and an era of more expansionary fiscal policy to be an era of higher neutral rates, that the broad economic forces driving neutral rates down are basically much stronger. And so what will be necessary to normalize monetary policy is some short rate way short of 5, more like 2. And if that happens, then I think that is something that can be achieved and probably can be managed in emerging markets. And actually, if there comes to be an expectation that we're in a new, low, long-term world of 0 or negative real rates, that could be quite a bullish factor for emerging markets. So I think the large question, in addition to the short-term question of inflation and overheating, I think the medium-term macroeconomic question for thinking about fiscal policy and monetary policy, for thinking about financial markets, is whether this secular stagnation trend that I've described is a semi-permanent one. Nothing's forever in economics, but is the right way to think about the current generation, or whether that's all going to sort of mean revert. And that's the question that if I had a looking glass that would tell me what the answer to that question was, then I would feel that I would have a more confident answer about the future of emerging markets.
Yeah, no, that's just exploring a little bit more this dilemma, because we are in a completely different moment than the pre-stagflation discussion, right? Where correctly you listed the fundamentals for your, let's call, structural concern. Having said that, the pandemic, of course, changed dramatically the short term, but in terms of monetary and fiscal expansion, and now we are discussing inflationary threat and so on. But this is relatively short term, right? We all imagine that normalization will happen, and these will be problems that will be behind us on the middle term. Do you think this transformation that the pandemic could cause in the society, more from the sociological side than the economic side, but of course with important consequence, can avoid definitively these stagflation risks? Or in other words, if we have a small roaring 20s ahead of us, this will be enough at least to postpone for another decade or two this stagflation threat?
I'm not sure I 100% understood what you were asking, but I think that we, for the next 2 years, I think the greater threats have to do with inflation and very large demand meeting with limited supply, and that generating inflationary concerns. I think that for the medium term, my expectation would be that its matters are much less clear in terms of what the neutral real rate is going to be. I think that we have not fully faced the fact that there's likely to be somewhat more longer term damage to potential GDP from COVID than I think people have tended to guess. My suspicion is that many people who have left work are not fully going to return to work or are not going to return to work quickly. My guess is that there are going to be habits with respect to work that people are going to lose. And I think in this environment, you're likely to see some greater sluggishness in productivity growth as measured over the next few years than I think many people expect. You know, some of the productivity statistics in recent months have looked pretty good. I think there's a dynamic going on there that's typified by the restaurants I frequented when I was on summer vacation. I would go to a restaurant that usually had small restaurant that usually had 5 waiters, and it only had 3. And the 3 were working really, really hard. And so you could look at that 2 ways. One is you could say that the measured productivity statistics, that restaurant was doing great. The number of meals served per person employed was way up. Or another way you could look at it was that the waiters in that restaurant were working unsustainably hard and that some of them were going to quit, or some of them were going to demand very high wage increases, or some of them were going to take a bunch of time off in the period immediately ahead. And that all those kinds of behavioral responses were going to operate in the direction of meaning lower productivity and lower potential GDP in the future. And I've got a feeling that in one way or another, we have a fair amount of that second type of mechanism going on.
Yeah. And Larry, moving a little bit more to microeconomics, but still inside the transformation of the pandemic. We had, you mentioned the mismatch between demand and supply, and part of that is related to a very important disruption in number of global supply chains. Do you see some structural transformation, or in other words, some regionalization of supply chains that can change the way that, or in a relevant way, the way that big multinational companies operate in order to avoid this kind of situation that we are today?
My guess is, and it's only a guess, is that it may well be that the high point of global supply chains has passed. Peak chain length may have passed. And I think that's for 2 reasons. One is, I think the events of the last couple of years have caused everybody to put more emphasis on just in case rather than just in time. They've just seen more supply side interruptions. I think that the spectacle of Americans not having enough masks has had a kind of enduring impact. And I think that's going to affect the behavior of many firms. China is not just another country. China is a large part of emerging market manufacturing, and a great deal of global supply chain involve China. And I think the combination of deteriorating relations between the United States and China, changes in policy directed at reducing dependence on China, and increased uncertainty regarding China's future, given the rather dramatic interferences in the market economy in a number of spheres that have taken place over the last few years. I think all of that is driving anyone who was in equipoise before about a Chinese element in their supply chain or extra branches in their trade towards consolidation. That's the first 60% of it. I think the second 40% of it is that a lot of global supply chain stuff was about labor arbitrage. It was about some tasks required lower wage workers and some tasks required higher wage workers. And you need to have some of all of that if you're going to succeed. And you wanted to separate the tasks that were best done by low wage workers and best done by high wage workers. As information technology proceeds and there's substitution of robots in performing routine tasks, the advantage from outsourcing to places that are further away is likely to be diminished. And so I think the combination of IT and robotization combined with the political is likely to lead to a period of reduced supply chains. And so I suspect peak supply chain has passed.
Yes. I will come back to U.S.-China. But before that, Larry, well, you have been an economics professor for most of your career and pretty involved with research and pretty involved with research on innovation, which, by the way, you still are. How you are seeing the cryptocurrencies, the existence and what they bring in terms of financial innovation, like tokenization and digital currencies sponsored by central banks. How you are seeing this amazing innovation and eventually some traps around that?
There's a recent book that was reviewed in the Financial Times last week that argues that the reason why there was a substantial takeoff in Europe at some point at the beginning of the 17th century was a set of financial innovations. And that financial innovations that permit greater specialization, permit the movement of capital from lower value uses to higher value uses are immensely powerful in changing economies. So I think there is a kind of physicalist tendency to, when we think of innovation, think about quantum mechanics and new materials and that kind of scientific progress rather than institutional innovation. And I think institutional innovation is immensely important. And therefore, we should be receptive to the idea that these kinds of developments might be hugely important. At this point, my instinct is that blockchain is a very powerful idea because it's the next stage in what is a centuries-old trend towards enabling exchange and commerce without trust. And that it makes possible much greater specialization and much greater exchange when you can rely on systems to make the exchange work and you don't have to know and trust your counterparty. So I think blockchain is going to be a very powerful innovation that's going to change a very large number of things. I think that digital currencies are likely to play a role not unlike a kind of digital gold that is likely to find a place in many, many institutional portfolios. And I can easily imagine a world where digital currencies have a value equal to or even in excess of the current value of gold. Right now, I don't see a world in which there's likely to be my buying either a Hershey bar or a house with cryptocurrency. And so its use as a pervasive medium of exchange would be more surprising to me. I don't know what the right way to think about central bank digital currencies are. My own instinct is that it is better for the microeconomic functions around payments to be performed by the private sector. And I would be quite surprised the United States a decade from now has issued a central bank digital currency. I'm aware of the rather strong views in many circles that the Chinese are moving faster on central bank digital currencies, and that in order to maintain the role of the dollar, we will need to have a central bank digital currency, perhaps. But I suspect that given the number of thunderbolts, whether they're wise or unwise thunderbolts, you can debate, but it seems to me the idea that they're thunderbolts you can't debate. The number of thunderbolts that the Chinese have thrown with respect to economic and financial activity in the last 6 months, I suspect that it will be a long time before a Chinese-run payment system or a Chinese-run store of value system will come to be dominant on some global basis. That just doesn't seem to me to be the way things are likely to head. And of course, from the Chinese point of view, one of the great virtues of a CBDC is the information it provides the authorities. But in this part of the world, we're more likely to see that as compromising privacy than as enabling valuable information for the authorities.
Yeah. And Larry, well, we totally agree with you about the transformation that blockchain can bring and tokenization, including capital markets, right? We have been doing a lot of initiatives here at BTG. And on the other hand, I would like to listen to you. What do you think is the best explanation why we somehow have around $2 trillion in digital currencies in terms of value, and we have the same criticism or doubt than you have? And inside this 2 trillion, you have even currencies without limit of supply and others that consume enormous amount of energy. What is the best explanation for $2 trillion of unproved assets still there with more and more liquidity, with more and more interest? As you said, somehow institutional investors are starting to be part of this ecosystem. So what would be the economic explanation for that, if there is any, right?
I think it's the right question to ask. There there's a basic law of mathematics, which is name any integer, and there are many more integers above it than there are below it. And so name a price for Bitcoin, and if you invest in Bitcoin, as a matter of logic, you can't lose more than 100% of it, and you can make you can make 1,000% on your investments. And so there's a kind of, if you don't understand it, there's more room up than there is down. And I think there's a fair amount of that psychology that is operating. I think we know that the more a asset is clearly associated with some measurable denominator, cash flows of some kind, the more pinned down its price is. That's why bonds are less volatile than stocks, and why value stocks are less volatile than growth and prospect stocks. And this, in a sense, because there's no clear tether in terms of cash flows, but it's only about the future value, has more the character. So I think at the moment I was cut off, I was remarking on the fact that we had that Bitcoin didn't have, or crypto didn't have as natural an anchor, and there was therefore more arbitrariness in the pricing. And of course, there are many who are prone to make judgments based on extrapolation. And, all people make, what else can you learn from? You can learn from history. And history so far has been that if you bought this, good things happen to you. And if you bought this on the dips, good things happen to you. And people see that of the many people who could participate, most have not yet participated. And so there's a strong bull case. I think the question on the other side is, if you get a stock, you get dividends. If you get a bond, you get coupon payments. If you get a painting, you get the satisfaction of looking at it. What exactly do you get here, except the hope of selling it to somebody else for more later? And that's why I think everybody has to make their own judgment about this as an asset category. So I'm more convinced that blockchain will be a much larger feature of global economic and financial life 10 years from now than it is today, than I am that any particular kind of crypto will be a larger fraction of global wealth than it is today. But there's a strong bull case as well. So I guess I think that if I was an institutional investor, I might well think that it was more risky to be entirely outside it than it was to have a small fraction of my holdings in it. But I don't think I'd want to have too large a fraction of my holdings in it, given that it wasn't exactly clear what you were getting a claim to when you held crypto.
Yeah, well, I think you're right. Well, Larry, unfortunately, arriving to the end, I have one final question. Just going back, when we spoke about supply chain, we talked about China, right? And before the pandemic, I would say that the key topic globally in terms of finance was related to the U.S.-China relationship, both in commerce, geopolitical, financial. How you and China provoked number of reactions in U.S., both on the Republican side, on the Democrat side, in the U.S. society as a whole. So, and every time that we have a second a big country or region raising to be the number one or to be equal to the number one, it was a moment of instability. How you see this relationship of U.S. and China progressing? It should be a source of stability or instability, looking at mid and long term.
I think near term, I'm anxious. Seems to me that we're on a bit of a downward cycle. The U.S., for a variety of reasons, is being more and more provocative vis-a-vis China. You know, is this a moment when we really need to change the title associated with our office in Taiwan? Is it really economically necessary to be increasing the tariffs that we're placing on China? Our principal strategy, which seems to be mobilizing all our allies against China, is not one that's likely to be welcomed in Beijing. But at the same time, China is giving awfully little indication on any issue that it is attentive or sensitive to what the rest of the world thinks. So I think right now we're in a bit of a downward spiral. My best guess is that we will pull out of that downward spiral, but it hasn't happened yet. And I think if you take what are actually the world's biggest security problems, which I think are climate change and pandemic, it's hard to see how we'll solve them without more cooperation than we're getting right now from the United States and from China.
Okay. Well, Larry, thank you very much for joining us in this session. As always, a very nice chat. And I'm sure that contributed a lot to the reflections to our investors here. Once again, thank you very much, Professor Larry Summers with us. Thank you, Larry.
It was a privilege to be with you.